Happy New Year to everybody. This is Mo from Wall Street from Main Street, and today we have a returning guest. It's Eric Hadik. He is the editor of INSIIDE Track Trading and 40-year cycle. Eric, welcome back. Happy New Year's.
Oh, Happy New Year to you, Mo. Thank you for having me back.
No problem. You're back due to popular demand, and I think everybody wants to get your thoughts on what's happened in 2016 and what's going to happen in 2017 as well.
Sounds good. I'm ready to go.
All right. So first thing I want to look at is talk about the gold and silver market. So in your newsletter, you declared that 2016 would be the start of the golden year for the precious metals market. And for the first half of 2016, it was looking pretty good for gold and silver, with up around 25-30%. And then we had a sell-off in the second half of 2016 from July, pretty much from July to the end of the year. We had a brutal downtrend that occurred in the gold and silver market. So I just want to get your thought. What caused the sell-off in the second half in 2016? Is that something that you expected?
Well, even when I know our last interview was in, I think, June or July, and at that time I reiterated that I thought the advance for 2016 was done and that gold and silver would see a sell-off into late year. That was really the second phase of the scenario that I had outlined for 2016, really through 2018. And when from late 2013 to late 2015, when I was describing 2016 as the golden year, I had very specific expectations for that and what I meant by that. And the primary thing was that I thought gold would see its longest and largest advance in the last 3 to 5 years, and that would likely be about a 6-month advance and would need to get it up above 1350 in order to confirm that we had turned the corner. But at the same time, and I made this clear all through the first half of 2016, that does not mean that gold is off to the races. It means that an initial leg up is kind of giving notice that the bear market's done, and now we're transitioning into a longer-term bull market. And the first thing you normally get after that initial advance is a sharp retracement that will often take back 70% or more of what the initial advance was. And the key retracement levels that have been apparent in gold for the last couple of months have been down around 1117 to 1126. That's a specific retracement level that I look for in what would be considered a second wave, meaning the first pullback after the initial advance. And if gold can hold right around the 1117 to 1126 range, then it would be in the best possible position to start a third wave up, which is actually the second advance of an overall bull market. And that's the one where towards the latter phase of that third wave is when you see a more accelerated and more intense advance, which is what I'm looking at for late 2017 and into 2018. But in the meantime, I do think we are going to see a solid advance in the first half of 2017, but there's some specifics also associated with that. It's not just a off to the moon type of thing. And same thing with silver, that $16 was the retracement level that I was talking about back when we were up at $21.5. The outlook was that we needed to get back to $16 for silver to be in a stronger position from a trend standpoint and from an overall wave perspective, that you need a good solid pullback in order to show more longevity to an overall trend, that it's a trend that is just starting out on a relative basis and still has a lot more ahead of it. But again, I emphasize this, and I get a lot of blowback against it, with everyone telling me, no, gold and silver have to go to the moon right away, right away. That's not how a normal trend works. And the second half of 2016 proved that again, that the timing is not right for an all-out accelerated break through every resistance type of advance yet. There is a specific time frame when I think that's far more likely, but that's not in the immediate future.
So how were you able to determine that you thought that a sell-off was going to occur in the second half of 2016, or were you just following the trend?
No, actually, I was going against the trend, the 3 to 6 month trend in back in late 2015 when I said we should surge into mid 2016. That was against the trend, and even in July when we had our interview and I said it was heading down from there, that was really going against what most people were perceiving as the trend. It has more to do with longer-term cycles. And back in late 2015, I was explaining how the very end of 2016 was actually when some precious metals markets, like the gold stocks, when they would see their most important bottom was at the end of 2016. And along with that, saying that gold and silver would likely see a secondary low at that time. So it was very cyclic in nature, but there are also key indicators that I follow. And one of them had to do with this, what I call a foreshadow indicator. And it's once gold and silver do exceed the magnitude of the recent, and by recent I mean the previous 3 to 5 years, the recent rallies, once they exceed the largest of those rallies, then it shows you that they've kind of expended all of the initial energy they have, and they need a period of retracement that's often pretty equivalent in time to the duration of the initial advance. So that also fit, having that 6-month advance and then a nearly 6-month pullback in the precious metals. But the good thing is that in equal duration waves, about a 6-month advance and a 6-month decline, the magnitude is not as sharp on the down cycle. So that's showing you some underlying relative strength too, just reinforcing that we're in a bottoming phase, and that there is still more positive outlook looking out over the coming years.
So I'm looking at the chart for silver right now. It looks like it's holding strong around the $16 support level. So going forward in 2017, do you expect something similar to what we saw in the first half of 2016?
I don't think it will be the same as that. I think when you look at it on a wave structure, that it will there will be some parallels to what we saw in 2016, but I actually think it will shrink down a little bit in degree to where there will be a 3 to 4 month advance and then maybe a 2-month or so pullback. And what that will be is kind of a type of fractal of what we saw last year. And so it mirrors it in how it looks in appearance, but the magnitude, it's on one lower degree in a wave structure, and so it unfolds over a shorter period of time. And the reason for that is that you're now seeing a 1 and 2 wave of the overall third wave that's developing. So you kind of get this pattern of up, down, but it's on two different magnitudes, two different scales of trend. So I think that there will be some parallels, but if you're looking for the same 6 month up, 6 month down, I don't think that will be the case. And there are some really critical cycles that I'm looking at in 2017, and really one of the most significant, not just from a precious metals perspective, but from a geopolitical perspective, and a lot of other types of cycles I look at, is in the March-April 2017 time frame. I think that's when things could really come back to life, and I'm doing a lot more explaining of that in my January INSIIDE Track newsletter, which is just coming out.
So you talked about geopolitical. Do you mind expanding on that? Or which event are you looking closely at in relation to the precious metals market?
It's a combination of a lot of them. I have described for probably the last 3-4 years these long-term cycles that I saw coming to a head or hitting a tipping point with relationship to Russia and to China in 2017, and they were independent of each other but kind of gave the same conclusion. But even more so than that, for the last 15 years, I've been talking about when I discuss long-term cycles. There was a scenario that I described back in early 2000s and have continued to update since then, but it had to do with cycles related to the Middle East, and those cycles were looking for kind of an initial intensification into 2008, then a little bit greater move into 2010, 2011, and then even a higher level intensification moving into 2017, 2018. And these are cycles that it's a convergence of so many different cycles ranging up to 100-year and 500-year cycles, all coming into play in 2017, 2018. But then within that time frame, there are a couple of key periods, and March, April of 2017 is the first of those that I'm really focused on. And it also incorporates a very intriguing cycle of attacks on America. Now, those attacks have taken many different appearances, even more recently being cyber-related. But there's been an 8-year cycle of attacks that I have traced back for the last 60 years, and that comes back into play in 2017. And like I said, most recently, you've had cyber attacks being one of those, but everything we've seen this last 6 to 8 months has just reinforced this cycle that it's kind of entering a crescendo. And I have another related discussion that I've had repeatedly over the last 15 years or so is what I call the date of aggression. And it's events surrounding that April 19th date, which I trace back throughout America's history and even world history as being such a significant time frame where you see different types of upheaval. And I'm not attempting to get real alarmists or yelling the sky is falling, as people often like to take what I'm saying out of context and really adding a lot of hyperbole to it. But it's one of those time frames when there's a greater convergence of these cycles of events that, you know, even if you can't tell exactly what's causing them, their consistent recurrence is so uncanny that you kind of ignore them at your own peril.
And that's very interesting. So we're going to have to keep our eye on the gold and silver market and see what it does in 2017. But I want to shift gears here and talk about the U.S. dollar. So recently, the U.S. dollar had hit the 14-year high, and that's due to various reasons. A lot of it is due to what's going on in Europe, what's going on in Asia with China and the capital control that they're trying to enforce to prevent people from investing in overseas. In India, we had a cash crisis where they got rid of the 500 and 1,000 rupees. So that's hurting the lower class and middle class in India. And then we got the euro and the European Union and their problem, and we got the UK that already left the European Union, and now we have Italy that look like they're about to leave the European Union as well. So I think the U.S. dollar right now is the best house in a bad neighborhood. I mean, it doesn't make U.S. dollar a sound currency right now, but it's just going up right now because a lot of people are just flocking the foreign currencies right now. So what do you expect for the U.S. dollar index going forward in 2017?
I have been looking for the dollar rally to stretch into 2017, and not surprisingly, a lot of my work has pinpointed March and April of 2017, and this, again, was completely independent of any of those geopolitical cycles. This had to do with specifically dollar-related cycles and wave projections, and everything has been focused on the second quarter of 2017 as being an important top in the dollar. So, you know, within that context, certainly means that there's probably going to be another rally between now and then. But it also wouldn't surprise me to see a decent pullback before we see that what could be a culminating rally. I have been discussing when in the context of the 40-year cycle analysis that I do, and I know we've talked about this in the past, but one of the things that I've traced back is this recurring battle between the dollar or other fiat currency. It's not just the dollar, but since that's been the kingpin in the recent phases of this cycle, that's the one that gets the most attention and the most focus. But between fiat currency and between hard currency, precious metals, gold and silver, and on a extremely consistent 40-year basis, this battle has kind of come to a head, and it goes through different phases during one decade each 40 years, and the 2010s were that decade this time, and they're related to the 1970s, the 1930s, the 1890s, 1850s, 1810s, all the way back to the 1770s. And you see very similar events unfolding, with ultimately being the paper fiat currency looking like a stronger thing in the early part of that transition phase, and then ultimately suffering at the end of that phase. And so what I have been describing for 5 years or so was that I thought 2013 to 2017 would be what I called the action part of that phase, and then 2017 to 2021 be the reaction, and that you would see the dollar strengthening throughout the first part of that into 2017, but all the while there would be fundamental events undercutting the dollar, and that started very quickly in 2013 and 2014 with many of the global currency basket events happening to start the ball rolling in trying to unseat the dollar. And I'm referring back to the Asian Infrastructure Bank and the New Development Bank, and those things that have been coming out of Russia and out of China and out of the BRICS nations. And that even while all those things were being put into place, which on the surface, someone might look at and say, oh, this is a potentially negative thing for the dollar. The timing wasn't right for the dollar to be selling off yet. And so these ducks are getting into a row, even as the dollar's increasing in perceived value. But I think that 2017 to 2021 is when you will then start to see the stuff hit the fan and start to see that global shift a little bit away from the dollar. I mean, the dollar certainly will probably be part of a basket of currencies for global reserve, but anything that starts to hint of the dollar being unseated as the king of the hill would certainly have an adverse impact on the dollar. And I kind of see that a little farther down the road in this 2017 to 2021 period. But I think that we're coming into the transition year where the dollar is going to see its last stand, its final advances, and then you will start to see things gradually begin to shift away from the dollar.
So let's talk about the danger of having a strong U.S. dollar. I did a video yesterday, and I talked about how it's going to hurt a lot of corporations that have investment overseas. And I think it's going to affect their earning as well, so we should expect some earning revision, which could also affect the stock market as well. So what do you think a stronger dollar and the effect it's going to have on asset prices, emerging market, and the stock market?
I think that with a lot of correlations like this, and I have an axiom in my trading manual that really addresses this, and it's the one I requote the most, and it has to do with market correlations, like you're discussing right there. They go hand in hand up to a certain point. And it's once you reach that tipping point, once the lead in that correlation kind of crosses the Rubicon or goes too far, that then all of a sudden you get this 180-degree turnaround in the correlation. And that up until this point, capital has been moving more towards the U.S., and so that benefits everything from the dollar to stocks, and up until the middle of 2016, it also benefited bonds. They've been kind of the first one to show some cracks or chinks in the armor. But often what you will see is the final move in whatever that lead market is. So if we're talking about the dollar, it can strengthen and strengthen and strengthen and strengthen, and that all looks good. And then all of a sudden, it goes from point E to point F, and that might only be a 5% move of what it has moved up to that point. And all of a sudden, the perspective shifts dramatically. And you also saw this on the downside. I discussed this back in 2006, 2007, when the dollar had been dropping since 2001. And I was pointing out in 2007 that the dollar was getting eerily close to what at the time were 40-year lows. And up until then, the perception was that, okay, a weaker dollar is benefiting exports, it's benefiting the U.S. economy, that's a good thing. And then you go from one level and maybe the dollar index drops 2 or 3 basis points, which maybe the month before it had dropped 5 basis points and no one really noticed, but that last 2 to 3 basis points are what suddenly dramatically shifts the perspective, and all of a sudden now everyone's talking about the dangers of a falling dollar. And the dollar did that. It dropped to those 40-year lows in September of 2007, and it was October 2007 when the stock market topped and then went into a 50% decline. It was this dramatic shift on a very small, almost minuscule move in the dollar, but it was the proverbial straw that broke the camel's back. And I think that we could be setting up for something similar with the stronger dollar scenario that we might see in 2017, where it gets to a certain level, and up until that time it's viewed very positively, and then all of a sudden it starts to attract more negative attention, and everyone rushes for the exits at the same time because the market always overreacts and the pendulum just swings wildly from one extreme to the other instead of any rational moves. And so I think that you're going to see that, and I think that the potential for the dollar turning back down in the coming years also fits with what I've been looking at for commodity markets and for price inflation from 2017 to 2021, and that has occurred on a very consistent 40-year cycle basis as well. So it all kind of fits into this bigger picture scenario, and I think that the dollar is eventually going to look like more of a burden, the stronger dollar. And as you mentioned, right now it's the healthiest horse in the glue factory. But I think there's going to be a shift away from fiat currencies, and that's when precious metals will come back more into favor.
Isn't it surprising that it's actually Bitcoin that's benefiting from all the currency and cash crisis instead of gold and silver right now? Because usually whenever there's a crisis with money, gold and silver usually benefit, but right now it's Bitcoin that's getting all the benefit right now, because if you look at what's happening in Venezuela, they're using Bitcoin to make transactions. A lot of people in China and India are starting to use Bitcoin, and that's starting to drive up the price of Bitcoin.
Yeah, and that kind of goes along with that whole correlation discussion that, gold, and I've said this before too, a lot of people want to correlate gold very closely to inflation.
Yeah.
And others want to correlate gold to geopolitical turmoil, war or attacks or anything like that. That correlation goes back and forth. It's not as consistent as a lot of people want to make it out to be. And the one correlation that I've seen the most consistent is to do with fiat currency, and that could be the dollar, that could be the euro. And when there is a crisis of confidence in one of those primary paper currencies, that's when gold and silver consistently move higher. And up to now, you've had the dollar providing some confidence, some support to that whole scenario. So gold and silver were not able to get going. And the euro had settled down this year. It has steadily declined over the last 4 months, but it has been a somewhat controlled decline. So neither one of those currencies is screaming crisis right now. So gold and silver have sold off, even though you've had the turmoil and the uncertainty of the election and of the interplay between Russia and the U.S. and everything that China keeps doing with the South China Sea, and all these potential boons for gold and silver have not moved the price, and that's more a function of there being a stronger, and I use that term very loosely, a relatively stronger fiat currency right now. But as you say, then there's Bitcoin too, that's a better reflection of the uncertainty and the geopolitical turmoil. That has a stronger correlation than gold and silver do.
And we'll see what happens over time to Bitcoin and gold and silver. But it sounds like you've been saying that 2017 to all the way to 2021 is going to be a major time period in our generation where we're going to see a shift in the economy, geopolitical, and also in politics as well, I guess, right?
Exactly. That has been the focus of a lot of my 40-year cycle analysis, but it's not just 40-year cycles. There's been 100-year cycles that time this type of geopolitical upheaval dating back 1,000 years. There's a very consistent 70-year cycle, and then there's shorter-term cycles, and it's not just cycles. I know when some of your listeners hear me mention that term, it probably just seems like some esoteric, mystical type of thing, but it's a reflection of human nature. It's a reflection of the ebb and flow of mass psychology, and it happens on a very consistent basis, and you're ill-advised to ignore that or to downplay it.
Now, do you think that time period will be a time period where we see a lot of crisis and tragedy in the economy and socially and geopolitically, or is it a little bit of both?
Yeah, I think there will be enough of that to certainly fulfill these cycles, but again, I'm not trying to sound like a Chicken Little or an alarmist. I certainly am watching the culmination of that period in 2021 for an increased potential for a more significant war, and there's a very consistent 80-year cycle that actually goes back way before our nation, but even in the U.S., 1781 was the culmination of the Revolutionary War, and then you move 80 years forward. 1861 was the start of the Civil War, although there were events for 5 to 6 years leading up to that, starting with the Bloody Kansas and some of the other events from 1855 all the way up to 1861. 80 years from 1861 was 1941, when Pearl Harbor and the U.S. involvement in World War II, although, again, there were events for several years leading up to that, including the war in Europe and between Japan and China. So it was smoldering, even more than smoldering. It was already catching fire, but the culmination came at that 80-year cycle period, and 2021 is the next phase of that cycle. And like I said, I even document it back long before American history, so it's got a longer time span and a little bit larger database corroborating that cycle. So I think that things are going to work in that direction. And there's also when you mention crisis, one of the things that I also have documented is a recurring food crisis. And that doesn't mean that it's worldwide, but it means that there are significant enough food challenges, crop challenges, to seriously impact the price, to see these spikes and these bubbles in a lot of food commodities, and that sequence comes back into play from 2017 into 2019, and even probably flowing over into 2021. But it is this 2 to 3 year time period that we're now entering that the greatest synergy of all of those cycles and those recurring events really converges.
So let's talk about the stock market. So right before the close of 2016, the Dow Jones was close to a record of 20,000. So we had all-time highs in the Dow Jones and S&P 500. And a lot of experts are believe that 2017 will be bullish for stocks, and we're seeing a lot of money going from bond market and into the stock market in the last month or so after Trump got elected. So I want to get your thought on what do you think is going to happen in the stock market in 2017? Do you think the stock market will continue to go up and climb this wall of worry that we're seeing right now?
I do not believe so, and let me step back a phase or two to give you kind of my broad stroke perspective and then bring it down to more specifically. But also aligned with that 40-year cycle, I've thought that we would see a topping phase in 2015, 2016 in the overall equity markets, and that includes the U.S. and global, and that incorporates many of the U.S. ones, since the Dow Jones Industrial Average can be very deceptive when it's viewed just on its own. So we would see this topping process take hold in 2015, 2016. What I described as my expectations for that 2-year period was about an 18-month period of just volatile two-sided action where we would see 1 to 3 months sharp declines, but they would immediately be followed by 1 to 2 months strong advances, and that's what we would see into the end of 2016. But then there's a greater synergy of cycles starting to turn bearish in 2017, and I think that that's going to start to apply more pressure on the markets. And the U.S. might be even with respect to equity markets, might be the healthier horse in the glue factory. But at some point when a lot of these other global equity indices and global equity markets in general see another downturn, which I expect, eventually that will weigh on the U.S. market, even if it's not to the same degree. But just since 2015, we've seen, China's market drop 50%, and since then it's only, and that was into February of last year, and in the 10 months since then, it's only recovered about a quarter of that drop. You saw actually a lot of the Asian markets, their initial down cycle in mid-2015 to early 2016 saw 30 to 50% losses in their markets. And then you see some other markets like in Europe, the DAX and the CAC 40 I'm watching, where they too saw an initial downswing and then a recovery. And it's kind of the opposite of what I was talking about with gold and silver, because this is now a topping market we're talking about. But you get that initial pretty devastating decline, but then you see a rebound that is a pretty substantial percentage of that initial down wave, and that's the second wave, and that starts to set you up for a more prolonged, a more expanded move to the downside over the coming years. And I think that still is what we're going to see, and it more likely starting overseas, not in the U.S., but then the U.S. ultimately giving in along with those other markets. And I'm certainly I'm watching Asia, but also watching Europe. You mentioned the Italian banks, but you look at the whole banking situation in Europe, from Italy to Spain, to a lesser degree to Portugal, and even Germany, and the warnings that the IMF came out with regard to Deutsche Bank last year. There's a lot of serious challenges there, and it's one thing when you've got one of them that the global monetary cabal rushes to put their finger in the dike of the dam. But when you've got 3 and 4 and 5 of these breaches, it becomes a lot more difficult to mask what's going on and to put a Band-Aid on it. And 2017 could be the year where you start to see a bit more leaking in that whole structure, and it start to become a little more spread throughout the globe.
Yeah, the European Bank had a serious liquidity problem, and also they have a big derivative problem too. Deutsche Bank, I believe, has $42 trillion of derivative in their books. So even a small bailout probably won't be enough to help them out. So yeah, and I think also the Italian bank had the same problem as well. So are you saying that 2017 we might see something similar to what happened in 2018 in terms of a stock market crash?
Similar to 2018, did you say?
I'm sorry. Are you saying that in 2017 we might see a stock market correction similar to what we saw in 2008, 2007?
Oh, in 2008. I think there is certainly the potential for that. Now, again, maybe some of the U.S. indices aren't hit with it as much as some overseas ones, but there certainly is the potential, and not all in 2017, but in the 2017-2018, maybe stretching into 2019 time frame, there certainly is the potential for that, I think, just from all of the analysis that I do. And it is one of those things where I can't tell you exactly what that first snowball is going to be that starts rolling down the hill, but once it does, you're probably going to see it picking up a lot of other struggles in its wake, and yes, the general scenario of what you saw in 2008 could come back to haunt the markets in the coming years.
Yeah, there's a lot of signs out there calling for a correction in the stock market, despite seeing the Trump rally that we saw the past couple months after the 2016 election. There's a lot of potential black swan event that could just pop up and just completely destroy the market, like we saw in 2008 when Bear Stearns and Lehman Brothers collapsed. So, and I'm sure you'll definitely let your subscribers know once that downtrend starts happening.
Yeah, and like you say, the Bear Stearns and the Lehman, that was, a couple years after the housing market had topped, and then the stock market topped, and throughout that, as I mentioned, you even had a crisis of confidence in the dollar in the middle of that, and it was that synergy of multiple events finally pushing the markets beyond the tipping point. And one of the, when you mentioned the recent Trump rally, the interesting thing about what we've seen the last 2 years is that it has been a very strong parallel to 1998 through 2000. And one of the other cycles that I'm convinced is one of the most uncanny in the stock markets is a 17-year cycle. And back in early 2007, before the market ever topped, I did a series of articles called the 17-year cycle, and they were also picked up by several magazines and newspapers and reprinted. And they were describing this 17-year cycle that was coming back into play in 2007, and it was projecting a 1 to 3 year drop of 35 to 50% in the stock market. And at the time, I was hearing a lot of the naysayers like I do now, but it was such an uncanny cycle. But my point is, there's actually two kind of overlapping 17-year cycles in the market. So that 2007, 2008 one is a different sequence, but in between that you have another cycle that's tied to 1998 through 2000, and then 17 years forward, 2015 to 2017. And I started describing that in early 2015. And one of the conclusions I had then was that we would see our initial sell-off between late April and late September of 2015, and that it should be at least a 20% drop, and that it would be similar to what happened in 1998 on the heels of first the Asian financial crisis in 97, then the Russian ruble crisis in 98, and it was kind of that combination of crises that finally hit the stock market, both in the U.S. and around the globe. And the Dow saw about a 20% sell-off back in 98, right in that middle third of the year. And it was actually a pattern had happened back in 1981 as well, 17 years prior to that. And I documented a similar cycle going back. And so one of my first conclusions when I was discussing this 2015-2016 topping process was that kind of the first shot across the bow or the first yellow flag should be a sharp in late April through late September of 2015, and that was when you saw China's market completely melt down. It's when you saw a lot of the European markets, the DAX, and others see these very substantial sell-offs, and our own markets that saw a very significant sell-off. And similar to 17 years ago, some of the indices have now made it back up to new highs. And 17 years ago, it was January of 2000 when the Dow peaked and then entered a 2.5-year bear market where it lost a lot of the indices lost 40 to 50% of their value. At the same time, the NASDAQ 100 that had led the whole bull market of the 90s lost, I believe it was 80% of its value in that 2-year period. So you kind of get an idea of the divergence and disparity among the different indices and what may be leading on the way down. But this 17-year cycle is coming back into play in 2017 through 2019, and could be a little bit like what we saw in 2000 to 2002.
So 2017 will be an interesting time for the stock market, for gold and silver, and for the U.S. dollar. One last topic I want to talk about before I let you go is the bond market. A lot of interesting activity has been going on in the bond market the past couple months. As we mentioned before, a lot of the money is going out of the bond fund and going into the stock market. Just want to get your thoughts on the bond market before I let you go.
I think that we have definitely seen a multi-year top. 2016 was the year in focus for several years now. 2016 is part of that 40-year cycle, and if you look back at 1976 to 1980, that was really the biggest surge in interest rates we've seen in our lifetimes, and that was 40 years ago. 70 years ago, 1946, was the lowest point that interest rates hit in the last century, and so 2016 was set up to be a critical phase of a 70-year cycle. And even when you take that 40-year cycle back to the phase immediately before it in 1936 to 1937, that's when you saw interest rates had been dropping into 1936, and then all of a sudden there was a monetary tightening leading into 37, and the stock market saw one of its biggest drops in the last century, although a lot of times people overlook the drop that began in 1937 because there was such a bigger drop in 29 to 32. But 1937 started a 40 to 50% drop in the stock market, but at the same time it was when interest rates had taken an abrupt turnabout from 36 into 37, and there's a lot more factoring into that. I'm just mentioning some of the bigger picture multi-generational cycles, but they all pointed to 2016 as the time for interest rates to bottom and probably see an up phase in interest rates from 2016 into the end of the decade. So it has, the action in the last 6 months has certainly fit very nicely with that scenario. And if I'm right, and we do see a combination of some food and crop challenges, some inflationary commodity prices in the coming years, that also could weigh on bonds by pushing interest rates higher, or at least the perception of interest rates needing to rise.
We've been saying for the past couple of years that the bond market is in a bubble due to artificial demand, and the Federal Reserve keeping the interest rate low. Now we're starting to see the spike in interest rates, which is affecting a lot of things, especially the housing market. So we're seeing mortgage rate go up, credit card rate goes up, so it's making borrowing a lot more expensive. So do you think that's going to also have a negative impact on the economy overall?
Well, there's in a couple year time frame, yes. In the immediate, not necessarily. And a lot of times that first turn, paradoxically, that could be something that wakes up home buyers who think that they had, from now until the cows come home to think about purchasing or upgrading homes because interest rates would always be, so low. All of a sudden, when you get that initial turn, that's often what wakes up some of those investors or even individuals, and it can actually have a little bit of a positive impact, even though it's probably more of a dead cat bounce type of thing. But just like I was describing with the stock market and inversely in gold and silver, with respect to bonds, you've seen this 6-month sell-off, and because for the most part they peaked in early July, bonds and 10-year notes, and that is kind of the first shot across the bow, but it doesn't mean that bonds are just heading straight down from here. You could see a reaction that is a pretty significant rebound and recovers a decent amount of the ground that's been lost, and that's your second wave before a bigger decline. So right now on the 3 to 6 month time frame, it wouldn't surprise me to see bonds kind of stabilize, find a floor under them, and start to rebound. And maybe you'll get this perception that rates aren't going to go too high too fast, and everyone gets kind of placated for a little while, and then later on in the year and then flowing into 2018 is when I would expect to see the second shoe drop where that's concerned. So it is that kind of same wave structure, trend structure, the way the markets typically work, that we may be nearing an initial bottom in bonds and notes, and we could see some consolidation throughout the first half of 2017 as a result.
Well, Eric, it's always good to talk to you. If people want to find out more about your newsletter, if they want to subscribe, where can they go?
They can go to our primary website at INSIIDETrack.com. That's spelled with the extra I in the middle, so it's INSIIDETRACK.com. They can also read a lot of the additional analysis and reports on 40yearcycle.com. That's the numbers 40 and then the words yearcycle.com. But to contact us, doing it through INSIIDETrack.com is the best way, and we can send out some samples and other subscription information and anything else that may be of interest.
Well, Eric, it's always good to talk to you. Hopefully you can come back on again soon.
Yeah, I would enjoy that, Mo. Thank you for having me back. It's always a pleasure.